What's up, guys? This week we are going to review some questions on the Schiller case, which is mainly about behavioral finance, and the chapter about behavioral finance. So for the Schiller book, Professor Ricci proposed several questions, and now we're going to answer some of them briefly. Number one, characterize the historical relationship between dividends and stock prices. So in the book, Schiller claims that stock prices have been moving too much that can be justified by dividends. That is, dividends are quite steady, while stock prices are not. So how do we explain this phenomenon? Behavioral financial theorists propose behavioral finance approach, and now it's the most widely accepted approach to interpret the market anomalies. Well, does the group have any arguments that would contradict Schiller's conclusion about the importance of the relationship in today's markets? The relationship between dividends and stock prices still stands when we are valuing stocks that has a very steady cash flow or very steady dividends. So for utility stocks, this relationship still stands. Dividend is still the key factor of valuation. But for Schiller's point of view, stock prices have been moving too much that can be justified by dividends. This relationship might help when valuing tech stocks or valuing stocks of the biotech company, the internet company, the companies of the unicorn club. So to sum up, Schiller's point of view is very important when we are valuing new tech stocks, while the dividend discount model is still important when we are valuing stocks, when we're valuing firms that has very steady cash flow, like utility firms, utility companies. Number two, Schiller lists 12 factors that explain the speculative market in the 1990s. How do these factors differ from what he calls rational analysis? First, we have to know the two notions. What is a rational analysis and what is Schiller's 12 factors? So rational analysis is mainly based on economic fundamentals, based on the assumption that everyone is rational and makes their decisions based on economic fundamentals, while Schiller's 12 factors are not warranted by economic fundamentals. Those 12 factors contributed to the self-fulfilling prophecy or psychology of a roaring stock market. This self-fulfilling process binds the bubble. According to your group, which factors might have had the largest contribution to the speculation? Well, in my opinion, the increasingly optimistic forecast and of the analysts and the inflow of pension plans and mutual funds might have the largest contribution. In Schiller's book, the expansion of the mutual fund industry um, is an important reason why we are now standing in the current financial market. Number three, how do psychological anchors influence stock prices? What is the implication regarding market efficiency? So there are two anchors that influence stock prices in Schiller's book. One is the quantitative anchors, that is whether the stock is priced right. And another is moral anchors, whether to invest in stock market or to invest in money market or to invest in gold. So for quantitative anchors, almost every time the overconfidence is involved, because when you are valuing the stock subjectively, it will involve your overconfidence. So what is the implication? The implication is that psychological biases always present in the stock market. So the price will not always reflect the information or fully review the information. That is, the market is not efficient. Number four, what is implied by the term smart money? Can we develop an investment strategy based on following the smart money? If so, how? Well, what is smart money? Smart money always buy low and sell high, and they profit from market mispricing. But we must know that it's hard to outperform the market as a whole. Although an obvious way, if we are truly smart, well, I should add a quote on it. If we are truly smart, not if we think we are smart, the most profitable way is to do the opposite of the not so smart money. Following so-called smart money may fail, but exploit market mispricing will not. That is, if you know what the stupid investors are doing, then doing the opposite will give you huge profits. Number five, do you believe that markets are efficient? Schiller discusses several anomalies associated with efficient markets. List one or two that the group would consider as an investment strategy. How would you execute the strategy? Well, in my opinion, market is not efficient because the traders on the Wall Street always say buy the dip. Then buy the dip is a simple strategy that exploits the temporary market mispricing. The final price will eventually be driven to the intrinsic value or near the intrinsic value and exhibit some efficient market characteristics, but it's not efficient market, it's not EMH. It's only because the presence of the arbitrageurs, and arbitrageurs might have information advantages that is not reflected by market prices. So in my opinion, EMH does not hold. Chapter 12, Behavioral Finance and Technical Analysis. Number one, explain how some of the behavioral biases discussed in the chapter might contribute to the success of technical trading rule. So what is a technical trading rule? Technical trading rule is based on technical analysis, which is basically when you look at the candlestick chart and you make your decision on the trend, on the crosses, and on the reversals, on the momentum. So it can generally be viewed as a search for trends or patterns in market prices. Technical analysts tend to view these trends as momentum or gradual adjustments to correct prices, or alternatively, reversals of trends. A number of the behavioral biases discussed in the chapter might contribute to these trends and patterns. The first is a conservatism. So what is a conservatism? You gradually take in the information. So if you gradually take in the information, there will be some momentum or gradual adjustments. Number two, representativeness, which is investors tend to inappropriately conclude on the basis of a small sample of data or some inefficient information. In this case, momentum or gradual adjustments will also build. Because when information is fully reviewed, there will be a reversal of trends. Number two, why would an advocate of the efficient market hypothesis believe that even if many investors exhibit the behavioral biases discussed in the chapter, security prices might still be set efficiently? We have seen this phenomenon many times, but it's mainly due to the presence of arbitrageurs. So even if many investors exhibit behavioral biases due to the presence of arbitrageurs, the prices will be driven to their intrinsic values. Arbitrageurs who observe mispricing in the securities markets would buy underpriced securities or sell overpriced securities to profit from the current market mispricing. As a consequence, security prices will present EMH characteristic, but it's not EMH. It's the consequence of the action of arbitrageurs. Number six, Jill Davis tells her broker that she does not want to sell her stocks that are below the price she paid for them. She believes that if she just holds on to them a little longer, they will recover, at which time she will sell them. What behavioral characteristics does Davis have as the basis for her decision making? Well, this is the version to realize her losses. So it's loss aversion, because the loss have been made on the book, but Jill Davis does not want to realize, to the money terms. It's just book terms, but she does not want to realize it. Match number 9, match each example to one of the following behavioral characteristics. A, investors are slow to update their beliefs when given new evidence. This is conservatism, because we gradually take in information. B, investors are reluctant to bear losses caused by their unconventional decisions. This is regret avoidance, because they are reluctant to bear losses caused by their unconventional decisions. They don't want to make decisions that will make them regret. C, investors exhibit less risk tolerance in their retirement accounts versus their other stock accounts. This is mental accounting, because in money terms, they are the same. There's no difference if you lose money on your retirement account or on your stock account. But investors tend to say that, well, it's a stock account, I can lose more money on stock account because they are intrinsically more risky, riskier, and this is wrong. This is just mental accounting. D, investors are reluctant to sell stocks with paper losses. This is the loss aversion, or we call it disposition effect, because they don't want to realize the effect in money terms. They just want to dispose it only on the paper. So it's disposition effect. E, investors disregard sample size when forming views about the future from the past. Well, this is representative bias. You made your decision on a small sample of information. CFA problems. These are very typical CFA level 3 problems. Louise and Christopher McLean, they have said that I have used the internet intensively to research the outlook, and I believe now is the best time to buy a house. Well, this is certainly illusion, because what can you know from the internet? On the internet, there are some folks that just say random things and you believe it and you invest it and you will fail. B, I do not want to sell any bond in my portfolio for a lower price than I paid for the bond. Well, this is certainly some anchor. Well, we call it a reference point. It makes no sense if you know you will lose money if you stick to this anchor or if you stick to this reference point. See, I will not sell any of my company stock because I know my company and I believe it has excellent prospects for the future. Well, this is familiarity and representativeness, because they just made decision based on a small sample of information. And as an employee, they don't know everything about their company. They just buy the company because of a home bias, what we call familiarity, more frequently as home bias. Number 4, during an interview with her investment advisor, a retired investor made the following 2 statements. I've been very pleased with the returns I've earned on Petri stock over the past 2 years, and I'm certain that it will be a superior performer in the future. Well, this is overconfidence, because who knows what will happen to the stock. There's no reason that you believe it will be a superior performer in the future. B, I am pleased with the returns from the Petri stock because I have specific uses for that money. For that reason, I certainly want my retirement fund to continue owning the Petri stock. Well, this is mental accounting, because this investor separates her retirement fund from her stock fund. If you lose money, it's the same. It doesn't matter which fund the money is in. So this is mental accounting. Electronic investment exercises. Calculate the 4-month moving average of both the stock and S&P 500 over time. So this investment exercises just wants us to practice the technical analysis. Basically, you see the candlestick chart and make your decision. based on moving average. The link is at finance.yahoo.com. We use 4-month moving average as benchmark to see if the stock is undervalued now or overvalued or correctly valued, or if there's some price momentum or long run reversal. And B is to calculate the relative strength. What is a relative strength? The relative strength is your average gain over your average loss. Average loss. And the relative strength index is 100 minus 100 over 1 plus the relative strength. This is very easy, and you can perform your analysis for both the stock price and the S&P 500. Does it matter whether the price crosses the moving average from above or below? Well, this certainly matters, because if you cross the moving average from below, there is an upward trend. But if the price crosses the moving average from above, well, there is a downward trend. Number 2, the finance.yahoo.com charting function allows you to specify comparisons between companies by choosing the technical analysis tab. Well, this is the same as the previous question, and you just graph the stock price of the two companies and see which company is priced above its 50 days and 200-day averages. Would you consider their charts as bullish or bearish? So how do you consider it's bullish or bearish? We have to know the golden cross and the death cross. So the cross refers to two simple moving averages crossing over each other. A golden cross is considered a bullish sign. It occurs when the 50-day moving average rises above 200-day moving average. A death cross is considered a bearish sign. It occurs when the 50-day moving average drops below the 200-day moving average. So that's what question B is mainly about. And you can search for the short interest ratios for the two companies. That's all for the chapter about behavioral finance. And if you have any questions, feel free to write me an email. See you next time.